Hey everyone, welcome back to Corporate Decoder, the place where we uncover the secrets hiding behind those thick stacks of SEC filings and maybe find a few hidden treasures along the way, or perhaps a few skeletons. Today we're diving into Linkage Global Incorporated latest amended filing, and let me tell you, it is a wild ride through convertible notes, shifting revenues, and a whole lot of legal and financial gymnastics. So first off, this isn't about Linkage Global Incorporated selling shares directly. It is about a shareholder, let's call them our selling shareholder, who wants to sell off a whole truckload of shares, about 9.3 million of them. These shares come from a convertible note they hold, a note that was originally for $3.5 million. Now, this isn't exactly a smooth ride. The conversion terms are complex, with prices that can change based on market performance, potentially giving the selling shareholder even more shares if the stock price drops. Talk about a built-in incentive to see the stock go down. And how did this note come about? Well, Linkage Global Incorporated sold it at a discount, meaning they already gave up some value up front, paying out a 10% discount. It raises the question, why sell it at a discount in the first place? Now let's look at the financials, because that is where the real story unfolds. We're going to check out their latest update, focusing on the 3 months ending the 31st of March 2025, and compare that to the same period a year ago. Their total revenues took a pretty significant hit, dropping by about 27% from nearly $4.8 million down to $3.5 million. That is a substantial decrease, and it means they're bringing in a lot less money than before. A huge part of this drop comes from their cross-border sales, which fell by a massive 82%. They used to make over $4.5 million from this in early 2024, but now it's down to just $800,000. This decline is blamed on their product strategy in Japan not working out and 3C electronic products not being popular, meaning these items, which are not everyday necessities, saw a big drop in sales. They're now trying to shift focus to a new business called Fully Managed E-Commerce Operation Services, apparently because it has higher profit margins. It seems like they're trying to pivot away from what is not working, which is a smart move, but it also shows that their previous strategy was not successful. On the flip side, their integrated e-commerce services saw a huge jump, growing by over 900%. This is mainly thanks to that new Fully Managed E-Commerce Operation Services business they started. This new venture brought in $2.59 million in revenue and seems to be their new hope. They charge a commission based on the total sales of the online shops they manage, and it looks like this model is a lot more profitable for them currently. However, their digital marketing services, which used to bring in revenue from Google commissions, are nearly gone. This business agreement ended in January 2025, and the company is even starting the process to deregister that part of the business. This shows a clear shift away from reliance on Google. With all these shifts, their gross profit actually shot up by an amazing 280%. This might sound great, but remember that their overall revenues decreased. The big jump in gross profit is mostly due to that new fully managed e-commerce operation service business. It has a really high profit margin, almost 95%. This is because they've already developed the necessary systems, so their costs are mainly salaries for the people running the online stores. Their cross-border sales had a better profit margin too, probably because of a shift towards higher margin products. Now, looking at operating expenses, they've almost doubled, going up by 91%. A big chunk of this increase is in general and administrative costs, which more than doubled. This rise is largely due to an increase in the amount set aside for credit losses, meaning they expect more customers to not pay their bills. They also had a significant stock-based compensation expense. This can happen when a company, especially after an IPO, grants shares to employees or executives as part of their compensation. The numbers here are quite substantial, showing a significant increase for the company. Other expenses also jumped dramatically, primarily due to interest expenses. This is because the company took on a significant amount of new debt through convertible notes, specifically $10 million with an interest rate that is frankly quite high at 42.52%. This new debt is a major factor in their increased expenses. All these factors combined have led to a much larger net loss. For the 6 months ending March 2025, their net loss was almost $3.1 million, nearly double what it was the previous year. Let's also take a quick look at the full year numbers leading up to September 2024. Their total revenues decreased by about 19%, mainly due to those cross-border sales continuing to fall. Again, the Japanese yen's depreciation is cited as a reason, making their products more expensive and reducing consumer purchasing power. The integrated e-commerce services, however, grew driven by that same fully managed e-commerce operations services business. Despite the revenue drop, gross profit actually more than doubled for the full year. This improvement is again largely thanks to the high profit margins of their new managed e-commerce services. But notice how their cross-border sales actually saw a decrease in profit margin, likely due to the yen's depreciation making costs higher. General and administrative expenses also surged by over 150% for the full year. This increase is mainly due to allowance for credit losses and financial and legal consulting fees, likely associated with their IPO and other corporate activities. Even with the increased gross profit, the soaring operating expenses, especially general and administrative costs, resulted in a much smaller net loss compared to the previous year. It shows the company is struggling to become profitable overall, despite growth in some areas. Now, let's talk about risks. Linkage Global Incorporated operates in China, Japan, and Hong Kong, and the risks associated with doing business in China are heavily emphasized. They talk a lot about changing government policies, cybersecurity reviews, stricter data security measures by the Cyberspace Administration of China, and potential impacts of US-China relations. These are not small issues. The company is trying to assure investors that they are compliant, but the sheer volume of discussion on these risks flags them as significant. There is also a mention of a dual-class share structure. This means some shareholders have more voting power than others. This can be a concern for regular shareholders as it can concentrate control, and the report specifically mentions this structure may be dilutive to the voting power of Class A shareholders. And then there is the Nasdaq listing issue. The company has previously had trouble maintaining a minimum bid price of $1 per S-share, and although they regained compliance, the report flags that if they fail to meet listing requirements in the future, their shares could be delisted. This is a serious risk that could significantly impact their stock's liquidity and value. So what is the big picture here? Linkage Global Incorporated is clearly in a period of significant transition. They're experiencing a major downfall in their traditional cross-border sales business, forcing them to rely heavily on a newer, seemingly more profitable e-commerce operation service. However, this pivot comes with increased costs, especially in administrative expenses and new debt. The company is also facing considerable geopolitical and regulatory risks, particularly related to China. Their financial performance remains a concern, with a growing net loss despite revenue shifts. While the new managed e-commerce service offers a glimmer of hope with its high margins, the company still has a long way to go to prove its sustained profitability and navigate the complex regulatory landscape. Investors should be cautious as the path forward appears challenging. What's your take on Linkage Global Incorporated's strategy and its financial health? Let me know your thoughts in the comments below. If you found this breakdown helpful, make sure to hit that like button and subscribe for more in-depth corporate analysis. And don't forget to join our Discord community for more discussions and insights, linked in the description. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.